Hello traders, today we are going to be looking at ICT key levels and PD arrays. So first of all, let's define what is a key level. What is a key level? Key levels are sensitive price levels which has the ability to reverse price. So basically, when you are trading using ICT concepts, you'll be looking to enter your trade at key levels. Okay. So, but what is PD array? PD array is the arrangement of this key level in the premium and discount zone according to their order of priority in a string structure. So what I mean here is this: whenever there is a string structure, maybe a break of structure or a shift of market structure, then when you mark your premium and discount zone, okay, then for a buy model, the discount zone, the key levels inside that within that discount zone, according to the arrangement of priority, they are called the PD arrays because they are arranged according to their order of priority. That's why it's called premium discount arrays. Okay, so for a buy mod for a buy model for a buy model, basically we have 7 ICT PD arrays. First of all, for a buy model setup, you have to consider the liquidity void first. Then, if there's no liquidity void, you consider fair value gap. If there's no fair value gap, you consider mitigation block. If there's no mitigation block, you consider the breaker block. If there's no breaker block, you consider the order block. If there's no order block, you consider the rejection block. If there's no rejection block, you consider old highs and old lows. Okay. I know you'll be wondering what is fair value gap versus liquidity void, what is mitigation block. I'm gonna show you, maybe not in this video, but the idea of this video is just to let you know the key levels, ICT key levels, or PD array, or PD arrays. Okay, so but I'm going to be showing you those things here on the chart, but I'm not going to explain exactly how to um mark them or identify them. I want just to show you them. My subsequent videos, I'm going to be showing you one after the other. I'll be treating it specifically. I'll choose one and treat it specifically to show you how you can identify it on your own chart. So for a cell model over here, you put your Fibonacci to from premium, from the high the low. Then you need to buy, for premium and discount, it means if you want to sell, you need to sell when price is is high. That's when price gets to the premium zone, price is already high. So when you sell from the premium zone, you will be you will make more profit. For a buy model, you need to buy when price is at a discount rate where it's cheaper. So once price crosses the equilibrium, that means the price is already cheap. So when price trades into this zone, when price trades into this discount zone, you'll be looking to either buy from the liquidity void, fair value gap, mitigation block, breaker block, because price is already cheap in the discount zone. Okay. Likewise, the sell model. When price gets into the premium zone, you'll be looking to buy from the liquidity void, fair value gap, mitigation block, breaker block, because price is already expensive. So you can choose to sell from any of these, depending on the one that is available. Okay, let me go to the chart and show you. It mustn't be that all the PD arrays must be available in a string structure, but you just have to choose. You just have to choose the one that is available. So like this current market structure. Okay, let me just delete all of this. Let me mark the PD arrays that is here. First of all, the first rule of marking a PD array, it must be a string structure, and for you to create a string structure, you need to have a break of structure or a shift of market structure, okay, or even change of character, any of them. So now we have a break of structure, and since here on the 4 hour time frame, there's no break of structure here. So the last swing point price created here is this. So I have to mark from here to here to this top, the higher high. Then I mark my equilibrium, which is this line over here. So I'll use that line as my equilibrium. Now I want to buy. That is, let me assume that this market has not even traded yet. So if I want to buy, I'll consider a liquidity void. Liquidity void are series of buy candles of, like for a buy model, liquidity voids are series of buy candle without a sell candle in it. So like this candle, this candle, this candle. This is a strong buying candles without a sell candle in it. That's what is called a liquidity void. Okay. Normally liquidity void is not always a key level, but you have to consider it because price has to fill it up before it continues. Now, fair value gap. Now we have a liquidity void which price has to fill up. That's liquidity void here. The next thing I have to consider is fair value gap. So within my, this is my, from this line to this top is my premium zone. From this line to this low, let me mark this low. I have two lows here. I have two lows here. I have two lows. This this low and this low within a swing structure, because generally this is the normal, this is the full swing structure from this low to this low, from this low to this high. But when I'm marking my key levels, I can choose the last low price created within this swing structure to decide my equilibrium. I can still use the last low, the highest low price created to mark my equilibrium. Anyone can go, but me, I prefer to use the last swing, the last swing low price created before you makes a high as my point of reference to mark my Fibonacci. So now let me mark the PDRs are available in this swing structure for a buy model. Now this is a fair value gap. Don't worry, I will still teach you how to mark fair value gap, but not in this video. If I want to explain everything one after the other, this video might reach 30 minutes, which is not good. So this is fair value gap. This is fair value gap. Then do we have a mitigation block? Yes. I have a mitigation. Don't worry, I'll show you how to mark mitigation block in my next video. I have a mitigation. Generally, let me just give you an idea of what mitigation block is. Mitigation block is when price shifts structure without taking a low, without taking out a low or a high. So something like this. The other block here is called a mitigation block. You see that there was a shift of there is a shift of market structure here without taking out this low. So this is what a mitigation block is. Let me just give you a rough sketch of how this thing looks like. Then a breaker block is when if price want to shift market structure and first of all took out a low before shifting market structure. Then the other block here, the last candle here, don't worry, I'll show you on the chart. So this other, basically this block here now is called the breaker block. Then the other block is the last opposite candle, the last, for a buy model, the last sell candle in a buy candle. That is called the other block. You may not understand it now, but I will show you on the chart. So first of all, let me see. So based on these two things I marked now, You can see only one of them is available. So you can see that there is a low here. Price made a high here. Price now made another low without taking out this low before it shifted market structure here. That means I have a mitigation block here, but not an order block or not a breaker block. So I mark mitigation block here. I have a mitigation block here. I have a mitigation block. Then for after mitigation block, since there is no breaker block, there's no need to. So if there is a mitigation block, there will not be a breaker block. Okay, one of these two will be used instead of each other. Okay, so after mitigation block, now I jump to order block. Order block is the last sell candle in a buy candle. So this is a bullish market structure. So for a bullish market structure, the order block has to be a sell candle. That is in a buy model. The order block has to be a sell candle. For a sell model, the order block has to be a bullish candle. So look at my order block here. I know this is still confusing, but I'll be explaining this in my next video. I'll be taking it one after the other to explain it because I can't explain it all once. So you can see that this video is already 11 minutes now without even me explaining the key levels one after the other. So this is other block. So but there's no need for me to mark everything. Okay, there's no need for me to mark everything because here all of them are almost aligning in this at the same place. So this has generated what is called a confluence. You don't need to mark everything. So what you need to do is to mark it according to your priority. Since you have fair value gap, we can just mark fair value gap and mitigation block and leave the rest. Okay. So now I have already marked my other block. Then the next thing is to get my rejection block. My rejection block is something like this. For this swing low, this is my rejection block. Okay, and the last one is old high and old low. So since I'm dealing with a buy structure, I'm going to be considering the low. Okay, but if it's a sell model, I'm going to be considering the high. So this this line I marked, this line here is my old low because this is the lowest point. This is the lowest point of this swing structure. There's another old low here. Okay, so this is also a key level. If price trade into this guy and rejects, it must not close below this line. So if price want to use the old high and old low, it must not close below or above it. So for an old low, price must not close below this low. It has to close inside. That is when I know that price is respecting this old low. Then I'll consider it as a key level to make my buy. Okay, so literally what I did here, I know is messy, but this is how trading is. Nothing is ever like simple. It has to be messy. Okay, but if I'm the one, if I'm marking this out, I'm not going to mark my other block. What I'm just going to mark is my I'll leave my old low, then I'll mark my fair value gap, and I mark my other block. You can see when after this shift of market structure here, okay, price trade into this fair value gap and then pull back and then pull back. So what I'm expecting here is, and if you consider this guy too, you know that there's been a shift of market structure here on the 4-hour time frame. Though the order flow is still bullish. If you have been watching my video, you can be able to identify what an order flow is. And so my order flow is still bullish, but market structure has shifted bearish here. Okay, that means I can still mark out key levels here because the condition for me to marking out key level is there has to be a shift of market structure, a break of market structure, or a change of character. So price has to shift structure before you can start marking out your key levels. So now after this shift of market structure here, because why it's called shift of market structure is price made a high, made a low, made another high, then made another low and closed below. So you can see that this structure looks like this in a reverse aspect, something like this. It didn't take out the high here before it closes below this low. So you can see this is um a sell model mitigation block. So after this market structure shifts, okay, I have now a breaker block here. Sorry, a mitigation block here. A mitigation block here, and I told you what is another block. Another block is the last candle before the last candle in a sell candle. That's for a sell model. The last buy candle in a selling market. That is a bearish order block. For a bullish order block is the last buying candle in a bullish order block in a bullish market. So I have my order block here. This is messy, yes, I know. So this is it, order block. So if you can see that when price traded into this fair value gap, it started going up. It didn't use this indication block because when you put your Fibonacci from here to here, you can see this mitigation block, part of it is in premium, part of it is in discount zone. So I'm not gonna consider um breaker block. I'm going to consider order block. You can see that this is where price is rejecting from. So you can see this is where price is rejecting from. Actually, this is not where price is rejecting from. Price is rejecting from the old high. If you take a close look at this, let me see. Let me check if price. Oh, okay. So pricing trade across it. So I'm talking. I'm going to consider the rejection block. Price traded from the rejection block. This is my rejection block here. So this is my rejection block. I know this is still confusing at this moment, but I'm just here is just to give you an idea of what is going on, how the key levels appears on a structure. So by my next video, sorry, in my next video rather, I'll be explaining them one after the other and be showing you practical examples of it, how you can use it in your own trade.